Hello, everybody. Thank you so much for joining us today. We're honored to be sitting down with Clif Droke. Clif is a longtime writer, currently as the Metals Research Analyst and writer for Cabot Wealth Network. You can Google his name to see that he always provides a wealth of information in his interviews. If you're looking to learn more about precious metals, equities, the stock market generally, as well as sort of, geopolitical concerns as they relate to the financial market. So thank you so much, Clif. We're honored to have you today.
Glad to be here. Thank you for having me, Justin.
So I guess, what have you been keeping an eye on either this month or this summer that just passed, or for the year in terms of metals, finance, et cetera?
Well, starting out this year, we were told that this was going to be the great reopening following last year's unfortunate events. And what I've been looking at is just very broadly is first and foremost, the reopening plays, stocks that would benefit definitely from a reopening, like the airlines, the cruise lines, hotel operators, none of which are performing. They're lagging the market, to say the least. And to me, that doesn't necessarily bode well for the great reopening theme. I'm also looking, of course, I follow closely the precious and base industrial metals, which is a very split market right now. I do look at Bitcoin to some extent, but by no means am an expert in that market. And general equities right now, there's obviously a surface show of strength, but a weak undercurrent. And right now, as we speak, they're being roiled by certain events in China. So I'm looking at things at catalysts that would cause volatility that would boost gold prices. And I think there's a lot of potential catalysts out there. It's just a matter of putting them all into play.
Is it the Evergrande situation in China you're keeping an eye on?
Correct. Yes.
What's your view on that?
Well, it's too early to say, really. I think it's anyone's guess at this point. Is it the next Lehman Brothers? I don't know. I kind of doubt the authorities there will let it get that out of hand. But it's sufficient enough to scare U.S. equity traders, and it's caused quite a bit of volatility recently in our markets. So and gold thus far has responded favorably to it. So if this becomes an ongoing concern, it could be a gold bull market catalyst.
What's been the action in the gold market like in 2021?
Boring, quite frankly. It's gold has not lived up to its potential, in my opinion. I'm not a perma bull, so I want to make that clear. I'm not one of these guys who's always cheerleading gold and saying it's got to go up all the time, no matter what. But I honestly can say this is one of the rare times, and I've covered gold for almost close to 25 years. I can tell you this is one of the rare times where I'm scratching my head. There's a lot of fundamental and technical catalysts that support a higher gold price, but gold is kind of in the doldrums right now. It's barely responding to any of these safety-related concerns that would normally push metals prices higher, that is, precious metals prices higher. So I'm at a little bit of a loss, other than to say there's not quite enough fear in the market yet in the U.S. to push people into the safety of gold. I think once we get that big injection of fear, we're going to see it, and it could be that Evergrande provides it for us. We'll just have to see.
Some events in recent times that I could see pushing gold prices higher would include, of course, the lockdowns altogether after an initial shock. I think that would freak people out, and it should have. We've seen the responses in especially the currency markets since that time. We've seen how 6 trillion printed in the US. So it would have been reasonable to say, okay, pandemic, the great lockdown, as the IMF termed the shutdowns, this reasonably should lead gold prices higher. And then, of course, there was an issue in the Middle East where I would say a destabilizing effect could have been reasonably presumed, which historically might have led gold prices higher. I think we saw that from 2000 to 2001, there was a steady bull market, particularly in silver and gold. And maybe that was catalyzed by the Iraq war. I think in the 90s too, there wasn't too much action after Desert Storm. However, generally speaking, gold bugs do argue that geopolitical risk should send gold prices higher, but we haven't exactly seen that. And do you have any ideas about like why that might be?
Well, it looks to me like no one is in a big hurry to go to war anytime soon. That could be part of it. I think there's two potential catalysts that could, well, let's put it this way, that will always send gold prices higher. General fear, it's a safe haven. Fear is gold's number one catalyst at any given time. Either the fear of inflation, the fear of deflation, fear of war, fear of recession. So we need to see some general fear in the market. I don't see a lot of it in the US because obviously people are still bullish enough to be holding equities near all-time highs in the S&P 500. I'll say something about Bitcoin. In my opinion, it's Bitcoin. I don't see it as a safe haven, as some people are arguing. I see it as more of a medium that people turn to when they're feeling kind of risky and they want to have that extra exposure to risk. It's to me, it could be viewed as a side bet to a bullish stock market. So when I see Bitcoin holding in there, the S&P going to new all-time highs or close to it, that tells me there's not enough fear in the market. And I think that's one thing holding gold back. And the other thing would be inflation, which is obviously becoming a problem here, but it's not sustained enough or persistent enough to scare people into gold yet. So it all boils down to just a lack of fear in my view.
On the Bitcoin note, I would say that I think that there is a certain degree of a general fear play there, especially among the non-institutional investors, perhaps, although they are citing inflation as a reason for getting into such assets. Now, it's really interesting, like it's almost a philosophical thought about the nature of the Bitcoin market. It's as if they, I read a book about the Soviet Union and it was called like everything was forever until it was no more. And it was this notion that the people in the Soviet Union thought that the Soviet Union would exist forever. And then one day it didn't exist and there was a general shock. People had never considered that on average, that the Soviet Union will one day not exist. And I think that Bitcoiners, they do make general fear plays, but they make it with this assumption that there will always be a perfectly functional internet, for instance. And I think that their fear doesn't run deep enough to have them understand that Bitcoin does have this fear element to a certain degree. And there is then this case for gold where you see Palantir recently. I'm not sure if you saw the news where Peter Thiel's company Palantir made, I believe, I get the numbers are so big, I get them sometimes mixed up. Was it 100 million gold purchase, I believe? And that was basically for a insurance against a black swan event. So I guess my point is that the retail level, if not the institutional level, there is this general fear play in the Bitcoin markets, but I think it's based on a less acute fear than you find at the retail level in the gold markets, at least. So it's interesting that from your perspective, you do see Bitcoin tracking the stock market because early on in its existence, it was a deflationary asset that was supposed to like represent everything that something like the stock market did not. But it's certainly evolved, particularly in 2017 during the ICO craze. There was I think a shift that was felt within the industry. That shift in Bitcoin might have started back in 2013 when it got really its first dose of mainstream media after it went to about $1,000. But really by 2017, it was felt that Bitcoin had at least stepped away from this strictly, I would say, safe haven concept into more like a financial play. And people argue that it's not correlated or it is correlated. And I guess over time, I think what you're saying is that it's becoming increasingly correlated, at least at this point. And that's maybe been its trajectory. And that'll probably be its trajectory as there's increasing institutional adoption. MicroStrategy just liquidated $600 million in stock. Where's that going? Is it going into Bitcoin? Some of it should go into gold, quite frankly.
I agree.
But now a couple of things. So there's a lot. I want to kind of like broaden out our gold discussion into like less that it's like a fear play and more that it's like an opportunity. For instance, here I am in North Idaho. These merchants should be throwing up signs that say they accept silver. But on the gold note, on how it's on the Bitcoin note and its evolution over the years, I'm not curious, looking at the grayscale share today, what's your opinion of where that's been and where it's going?
Well, I noticed today, I don't, obviously we're Monday, September 20th. This is the day that the stock market is being roiled by Evergrande. I looked at it briefly this morning and I noticed it was down 8%. So I mean, it's just a 1 day move. It's a micro move, but to me that confirms the view that it's not necessarily a safe haven. I wouldn't say that it's certainly a one-to-one ratio tracker to the S&P. It's not going to perfectly mirror the stock market, but I do believe it benefits more from a lack of risk aversion. When people are willing to take on risk, to me, they'll buy some Bitcoin. They'll move into the Grayscale Bitcoin Trust. But when I've noticed lately that maybe this wasn't true in the beginning, but in the last couple of years, I've noticed that when investors get spooked, the Grayscale Bitcoin Trust usually will decline. It seems to get liquidated or suffers from liquidation pressure. And I think we're seeing just a little of that today. So it'll be interesting to see how it continues to respond to this ongoing event in China.
I think hints at a clear divide or just different profiles of Bitcoin investor, and those that are like understand the philosophical underpinnings of Satoshi Nakamoto's writings and some of the stuff he put in the code. They are certainly driven, I think, by we call it fear, and certainly fear is perhaps one of the most driving factors behind human action in our world, for better or worse. But they also view it as an opportunity, kind of like as a parallel, an alternative. And that brings me to kind of like where the gold and silver markets are today. If people are not interested in these assets at the retail level, especially amongst the younger generations, as stores of value, then what other opportunities are there for precious metals? I see them as, I speak often on this show when I have precious metals guests. This is like my main pitch, is that there's got to be a cultural opportunity there where we can start incorporating, like the NFTs have done in the crypto world, gold and silver coins back into kind of popular culture, say like via partnerships with licensing deals with like the NBA, for instance. That's just like broad, that you could go in a billion different directions with that idea. That's just to say, put forth an example. And then there's this other opportunity maybe with it as a medium exchange, which it has been for quite a while. I was just reading the works of Alex Del Mar, who was a monetary historian at the end of the 19th century, who covered the history of money at that point. And he was a proponent of the bimetallic standard in the US. He has like some quote where it's like silver or death or something like that, but he loved silver. So I'm curious, like, what opportunities do you see for gold and silver, other than as a financial asset of speculation?
Well, other than as an asset of speculation, I would say its most traditional role, and the role that it will always ultimately fulfill, and I believe it will continue to do so, is that of a safe haven. I believe it belongs as a core, as an anchor in everyone's portfolio, even if it's just a small 5% or so of your equity portfolio in gold. As far as bullion or bullion coins, I'm noticing in the last couple of years there has been quite a bit of heavy demand for those. I think even the younger millennial crowd has discovered bullion coins. Certainly silver. We've heard about the silver stackers, I believe they're called, where they're trying to push up physically the price of silver by accumulating coins. It's a strategy that's not working. But I think that there is a general understanding that the coins are there. You can collect them and own them as either as for speculative purposes, for safety purposes. So I don't see that there's a lack of awareness there. I think the lack of awareness is gold is the ultimate safe haven in my view, and it belongs in every equity investor's portfolio, at least to some extent. And what usually happens is a market event or a major recession comes along and reminds everyone of that fact. It's a primal instinct. People turn to gold when there's genuine fear in the air. Fear so thick you can cut it. And we're not there yet, but I believe gold will come into its own, certainly within the coming year. And I don't think it needs any advertisement or promotion. People will just naturally turn to it when they are afraid.
We are like essentially on the cusp. We're witnessing some like historical events in the markets, particularly and just across the board. So I'm just curious, like, what's your general feel on the macro picture right now, and like, where does gold fit into that? You mentioned it's the ultimate safe haven. I think that's irrefutable, and this is something that the Bitcoin community like totally misses the ball on, and it blows my mind actually, quite frankly, as someone who, like so many of us, came to Bitcoin from gold and silver. It was never an either or proposition. And I mean, I own goldsilverbitcoin.com. I think that like essentially one's like entire portfolio could just be comprised of gold, silver, Bitcoin, quite frankly. I mean, I don't even know if you need fiat in that equation other than to pay for goods and services. However, you mentioned ultimate safe haven. It's like the safe haven of last resort. And I don't think you can argue otherwise, really. And I would also put silver into that um, kind of a class. However, there's certainly arguments which favor gold that I can't ignore. I'm curious though, like here we are. The stock market has just been on a tear against all odds. I guess apparently not against all odds, but against one's intuition. And I'm curious, like, do you ever sit back and think, wow, like I'm bearing witness to just like stuff that is earth shattering in some ways? And what do you make of it? And kind of what keeps you going?
It's truly a momentous time in more ways than one. I do believe history repeats, or at least rhymes. Have I ever seen anything exactly like this? Of course not. I don't think any of us have. I'll be honest with you, though. I'm beginning to see some parallels between what we're experiencing now in the late 90s. Up until last year, ever since the bull market started, the latest one in 2009, for years and years and years, that people were saying, "Oh, there's a bubble," because the market kept going up. It's a bubble. And my response was, no, it's not a bubble, because the public is not in. The retail, the small trader, the investor, they're not there. They hate stocks, they hate equities. So this thing is going to keep going up, because the institutions, the institutions have to have someone to sell to if they want to get out, and that's the public. The public isn't there yet, which means the bull market will continue. Well, now, within the last year or two, the public has come back, and they're starting to get really bullish. And do I believe we're on the cusp of a major, like a bear market? Not necessarily, because as we learned in the late 90s, it can go on 2 or 3 years before you get a serious major decline. I don't pretend to know when this will end, but I'll be honest, I'm getting a little uneasy seeing people getting bullish, the small traders getting bullish. And it's there's also a little bit of an undercurrent of weakness in the market. If you look at the new 52-week lows on the NASDAQ in particular, this has persisted for months on end. There's been a lot of below the surface selling pressure, particularly in healthcare stocks and SPACs. And we saw the same thing in 1999, and it went on for over a year. So that was before the market had a major top. So that's another thing that makes me a little nervous. And bringing it back to gold, gold didn't really come into its own until shortly after the year 2000, after the stock market had a major decline and we entered a recession. So I'm beginning to see the pieces fall together and in repetition of that late 90s, early 2000s scenario. And I do believe gold will come back into its own, as you said, the safe haven of last resort becomes clear to the masses. And we're not there yet. I don't know when we're going to get there, but I see that we're heading there in that direction.
It's almost inexplicable with what we're seeing in the physical silver market, where the price is almost divorced from the paper price. Would you agree with that sentiment? Because that's what the silver bugs say.
Yeah, I would agree with that. I certainly can't disagree with it. Silver has lagged gold, and which is, normally you'd like to see silver either keeping pace with gold or preferably leading. I recall that silver, was lagging gold in the early stages of its early 2000s bull market. And I think what's going to have to happen before silver really takes off, gold is going to provide the leadership. Because when people see gold going up persistently, they'll naturally turn to silver because it's a way to leverage a gold bull market, due to its lower price. So to me, the people ask, what's it going to take to kick off a silver bull market? Gold. I think gold has to go first. I don't see silver leading gold in the next leg higher.
Have you seen like the cost of physical silver have you seen such high premiums in the physical silver market as compared to like what you're seeing on the paper markets in your history of following these markets?
I can't remember. I can't recall. This could, in my 25 or so years, it could be a first.
What is the significance of that, you think?
Well, I don't pretend to know the significance, but it obviously it shows that there's a divorce between reality and between what we're seeing in the financial markets. I think silver bugs, if I can call them that, the people that are true blue on silver,
They are proudly silver bugs.
yeah, they know what's happening, and they realize that it does have long-term upside potential, and that there are problems that are going to need hedging against. And I think they're taking those early positions, much of it in the physical market, and sooner or later the paper market will respond to that. There's been a lot of accumulation of physical silver, and I don't see it being unloaded anytime soon. So somebody out there knows something big is going on behind the scenes, and they're preparing for it. That's my interpretation of it.
Now, the silver investors are responding to a lot of macroeconomic factors, but I think in some ways they're almost responding to like silver almost seems like one of the most undervalued assets in the world. I can't justify its price. I certainly am no market expert, but it intuitively just seems insanely undervalued. It's like what, 25 bucks? You can get it for 30 probably, physical. And wow, I mean, just let's take away the premium. Let's take away that there's the premium. Just the fact that it's been in the low 23s for a decade, of course, within, pretty much a decade, right? After it went to 49, 50 bucks, it kind of slowly fell back down to where we are today. It made some stops along the way, maybe the low 40s briefly, the low 30s. But then from there, it's pretty much just been hanging out in the 20s and even lower. I mean, if we see some sort of big event, silver very well could get to $12, $14, but you won't be able to get it for less than 30.
It's a total divorce from reality, really. Yeah. There's no other way to characterize it.
Now, just like relative to other assets and what you've seen in your lifetime, like how cheap does silver look? And I'm not trying to sell silver. I'm speaking intellectually. How cheap does it look?
I agree with your characterization. It is cheap. How cheap? I don't know, because in a situation that we're in now, how do you properly value it? But I do agree with you. It's I think the market participants that are buying physical realize its value. Normally, if there's a lot of retail traders involved, I would question it, as a case from a contrarian perspective. But this has been going on a good long while now, and I believe firmly that the physical market, sees that there are going to be problems ahead that will cause financial market volatility, and they're preparing, they're hedging for that. And I tend to agree with the silver stackers in this regard. So, is it undervalued? Absolutely. How much? I can't tell you, but there's definitely, it's a value play. I've been saying that about gold as well. It's a value play at this point.
Can you speak to some more of the parallels between the 90s, particularly the late 90s, and what you've seen over the last 10 years?
Sure. Well, obviously history doesn't repeat perfectly. It tends to rhyme. There are parallels. I can tell you that in the late 90s, obviously there was, the mania was on the at any given time, when you're in a situation where there's a wild bull market, there's always going to be a central focus. In the late 90s, of course, it was the internet stocks. We're seeing other aspects of that today with the popularity of cloud stocks and other emerging technologies. But what the main thing that I see repeating is just the small investor is becoming more enamored of the stock market, more enamored of just getting in and making money. What earlier was it last year or this year we saw the meme players and the people trying to create short covering situations, which reminded me sort of the day trading uh, craze of the late 90s. People just trying to play the short term minor fluctuations. That's always a dead giveaway that it's a greed thing, and that can't last. That lets you know that we're getting close to something major as far as a top. And the greed factor seems to be increasing, and that's the thing that I see most reminiscent of the late 90s. Just the greed of the small trader seems to be increasing.
What do you think? What do you think the culmination point looks like?
As far as how will this play out as at a top? Well, I certainly can't tell you when, but if history is any guide, there will be a bifurcation in the market. I don't think it will happen comprehensively where the tech sector, the industrials, all the major sectors go down all at once. There'll probably be some lags. I think it begins in the tech sector, which is what happened last time around in the year 2000. The tech sector is where most of the speculation is, and I think that will be the first to decline. I think it will actually be, if you want me to be a little more specific, I think it'll start in healthcare. The healthcare stocks will be the first, and then some of the trendier tech stocks will follow. Industrials and physical economy stocks. I'm talking about some of the stodgy Dow 30 type stocks will probably be the last ones to go. But I see it beginning in the tech sector, and it could get ugly. I don't see it happening this year, though. I think there's too much of a vested interest to keep the market buoyant. There's a lot of liquidity, and as you know, in the market, it's all about liquidity. And to me, there's still plenty of it. And until liquidity becomes a problem, this bull market couldn't persist longer than we think.
Why do you think the contagion will spread from the healthcare sector?
That's where to me, I see distribution happening already. I see liquidation happening under the surface because for months, as I mentioned, the NASDAQ 52-week new lows have been above normal. That's one of my favorite indicators, by the way, because to me, that is where you see the real incremental demand for stocks is in the 52-week highs and lows. And in my experience, when the 52-week lows on a daily basis get above 40, especially in the triple digits, it means there's above normal selling pressure somewhere in the market. And if you look at the stocks making the new lows, you'll see where it is. And for the last few months, it's been healthcare stocks, which tells me, biopharma stocks in particular, which tells me somebody has been unloading these particular equities, and probably some not your retail type traders, but people with professional or inside knowledge. So I see it starting there because there's just been so much distribution there.
Is this connected somehow to the attention on the healthcare sector over the last year and a half?
Probably. I certainly don't know all the reasons, but I'm guessing it does. Maybe somebody looks out into the future. Somebody with inside knowledge looks out into the future, and they see an unfavorable set of events for that sector, whatever that may be. So that's just the best guess.
You heard it here, folks, or maybe not. Maybe even saying that. I think that's significant, not only because people can know what to look out for financially speaking, but I think it says a lot socially. And of course, like you said, we don't know what is going on, but I mean, there's probably something there.
I would think so. It's been so, if it only lasted a few weeks or so, we could blow it off. This has been going on for a few months now, and doesn't ever seem to stop. It's been fairly persistent, and that, I'll be honest, it worries me a little bit. If I were a healthcare investor, I'd be a little worried.
Any other comments on that topic in particular?
No, I think we've covered it. It's just I would advise your listeners and viewers to keep an eye on the 52-week highs and lows, particularly the Nasdaq. That's going to give a heads up signal as far as the areas you should be avoiding, or when the market is strong, the areas you should be looking at if you're a momentum trader. So just keep an eye, particularly on the new 52-week lows, and that's the area that you should be watching in particular.
How has the healthcare sector performed relative to the rest of the market since March 2020? Have you been keeping an eye on that?
Well, it's certainly had an outperformance. Many areas of healthcare have been very strong, but here lately, we're finally. It's funny when the subsurface selling, as I call it, the 52-week lows and the biopharma stocks began a few months ago. A lot of the biopharma indices and ETFs kept going up, but I'm noticing here lately they're finally starting to droop and show weakness. So it's like a belated response to that internal selling, and finally they're showing weakness. But up until recently, they've been fairly strong.
How does the distribution you're seeing in the healthcare sector rank compared with other similar types of distribution you've seen in your many years of following the markets?
Well, again, the mind stretches. There have been a couple of times in the last 20 years that stand out. One was a few years ago. I think this was before that big, the decline we had in 2018 was the oil stocks. There was a couple of times it happened, 2018, and also we had another big decline, and I think it was late 2015, early 2016, which began in the energy sector. So there were several months where the oil stocks were under, distribution. They were showing a lot of weakness, and sure enough, not just the crude oil, but the stock market followed suit. And then going back further, of course, again to the late 90s, internet stocks actually started coming under heavy selling pressure in 1999. A lot of people don't remember that, but there was actually a big undercurrent of weakness in the internet stocks starting in around, I believe it was the spring of 99, and it went on for the rest of that year. And then you saw what happened in the year 2000. So that oftentimes it gives you, if that happens, if you start to see a sector showing abnormal weakness for months on end in the 52-week lows, that tells you what is going to lead the next broad market decline. And that's why I see healthcare leading the next one.
And then why do you anticipate the contagion spreading then first to the tech sector, other than because that's where a lot of this, I guess, speculation's been, or is that the main?
That's one of the reasons. Also, there have been a lot of SPACs on the Nasdaq that have been making 52-week lows persistently for the last few months. So, and the other reason, this is just anecdotally, just that is where most of the speculation is in the tech sector. So it stands to reason that what goes up the most will come down the most when the time comes, So I see that because there is such hyper bullish sentiment on some of those areas of tech, that's probably going to be where most of the selling occurs when people start to panic, whenever that is.
So we were kind of, I think, talking at a certain point about the big events happening today, and you compared it with the 90s stock market crash. In what ways is today different?
We have a financial sector, Wall Street, the Federal Reserve, even to some extent the federal government, heavily involved in, committed to keeping the stock market strong. In the 90s, it was all about the bond market. To me, the S&P 500 has supplanted the 10-year Treasury bond. Everybody is looking at the market. We have perfected our current financial sector has perfected the art of financial engineering. I believe I've heard that they even offer college degrees in financial engineering, if I'm not mistaken. They've basically perfected ways of introducing liquidity when it's needed. They can, to some extent, prevent major sell-offs, at least for a while. And to me, the reason we don't see as many panics and sell-offs like we did back in the 90s is because financial engineering has been perfected. It's gotten about as good as I've ever seen it. And for that reason, you cannot predict when the next major decline is going to happen, because they can keep this thing going a lot longer than you think.
Can you speak more to that? They perfected financial engineering. This is almost like Fukuyama's like declaration that it's the end of history, for instance, that he made in like the early 90s, which got quite a bit of, I think, play. It's for a academic concept in kind of mainstream popular culture. Can you kind of tell me about this, like the perfection of financial engineering, and what does that mean?
Well, the Federal Reserve has more policy tools than it's ever had. I believe governments around the world are more actively involved in, central banks certainly in intervening in the financial markets. We didn't see this nearly as much in the 90s. I mean, we have a Federal Reserve that's actively involved in purchasing assets, and other countries as well. That is an enormous liquidity boost that we haven't seen in past decades. That's part of it. It's just basically the concept of active intervention, governments and central banks actively intervening to prevent a general equity market malaise. This is something that it's relatively new, and perhaps perfection is the wrong word. Nothing is ever perfect, but I see that as the years go by, they've got more policy tools at their fingertips, and they seem to be getting better at it. So, there's always, as long as they provide liquidity, stocks are going to remain buoyant to some extent, and it's very hard to bet against that. So, the only time I would say we need to start worrying about another major malaise or market decline is when we see liquidity, interest rates tightening up, liquidity decreasing. That's when we'll have the next problem. I don't see it happening yet.
Why did the attention go from the bond markets to the stock market, and what are the implications of that?
When or where?
Um,
Either one.
Why, and all the above?
I think because stocks have just, from a cultural standpoint, they've taken on a bigger significance in the lives of the average American. People have become enamored with equities over the years and decades, notwithstanding the late, the tech wreck of the early 2000s, the credit crash. They look at the equity market, they look at the 120-year history, and they see stocks just go up for the long term. And they see that when the stocks do crash, the governments of the world, particularly ours, step in and intervene. Central banks intervene. They will not let equities suffer for very long. And they see that as, well, why should I keep money in low yielding bonds when there's an active intervention in the stock market and stocks just go up over time no matter what? So it's obvious that, to me, it's inevitable that people would start to prefer equities over bonds. And furthermore, stocks generally a lot of them yield more than government bonds. So there's that element as well. It's just a culmination of decades of observation, with people seeing that governments favor supporting equity markets, and there's no reason to be long-term bearish the stock market. So I think people are becoming more comfortable with the idea of just buying and holding stocks.
How does this affect the thesis that we kind of are heading into the kind of something that's similar to what happened at the end of the 90s with the stock, with the tech or the internet crash and bubble?
Well, obviously there will be declines, there will be bear markets, but there will also be interventions. There will be attempts to keep those bear markets from extending beyond what they normal parameters. Will the government ever be able to forestall them? No. There will always be bear markets. There will always be declines. But obviously, the vested interest right now is in providing as much abundant liquidity to the market as possible. And it's hard to fight against that from a long-term perspective. So I'm not one of these doom and gloomers who says, yeah, the market's S&P is going to go to zero or whatever. That I don't see that ever happening. As long as we have a U.S. government and a Federal Reserve, stocks will always have long-term value.
What's your 10 to 15 year view of the markets and particularly precious metals?
I'll be honest with you, that view is beyond my scope, but I'll answer your question. 10 to 15 years at best guess, higher stock prices. That is there's no, it's undeniably the long-term trend, and I don't believe in fighting the trend. I do see higher stock prices in 10 to 15 years. I also see higher precious metals prices as well. I think people increasingly will come to realize they do need a safe haven as the world becomes more turbulent. That also seems to be the trend that we've seen in the last 20 years. I think that bodes well for gold and silver, particularly gold. That seems to be its long-term trajectory. So short answer, higher gold prices, higher stock prices.
Higher manufacturing costs, higher costs of foods, higher cost of commodities across the board, I guess, is probably a trend that we're going to see. So like, what's the what's the longest term view that you are, I guess, studying and teaching, and what's your view of thereof?
I look at the K wave, which is, the 50 to 60 year commodity cycle, and to some extent interest rate cycle. It's the cycle of inflation and deflation. Where I see us in that, it's admittedly a nebulous. You don't know exactly where you are, but I see us entering the inflationary phase of the K wave, which means we probably have a good 10 or 20 years ahead of us more of inflation. I think we're just seeing the early stages of it. You just said it. I think we're going to see higher costs of living, higher prices categorically across the board for commodities. I also believe stocks, higher prices for almost everything. So I think if I could summarize the next, say, 10 to 20 years in a single word, at the risk of sounding trite, I would say inflation.
What do people need to know about inflation?
In the early stages, it can actually be beneficial. It's exciting. It causes asset prices to go up, which is part of what we're seeing now. As it becomes more entrenched, it becomes a problem because when it begins to affect the value of the dollar, when you're paying $5 or more for gasoline and all the costs associated with higher fuel costs and food costs, it's going to eat into your, it's going to eat into your lifestyle. And most people probably watching this don't remember that the 70s were a time of runaway inflation. And if you ever talk to someone that went through the 70s and ask them what was it like, they'll tell you it was like the worst economy I've ever seen, because inflation it just eats away at your purchasing power. And most people cannot identify it because they can't identify with it because we've never experienced it. But it can be devastating. Inflation is, when it becomes entrenched, which it'll take several years for that to happen. It stings, it hurts, and it's no fun at all. Let me just throw one thing out. A few years ago, Venezuela was experiencing a pretty severe case of it. If you look at their stock market, it was just soaring, going to the roof. So from an outside perspective, you might look at the Venezuelan stock market and say, wow, that's beautiful, great, good for them. No, they were just looking for anywhere to put their dollars. They were having a hard, it was a nasty time. So I can't describe it, but inflation is, when it becomes established, is not fun.
Any other comments on inflation generally? Because my prediction is that's going to be the hot topic and buzzword here moving forward for the foreseeable future, particularly once it'll be that initial excitement where inflation is the hot new buzzword, and then the reality will set in. So can you tell me kind of more about that?
Well, I can tell you that I agree with you, first of all. And I think the best way, and again, I'm not a gold salesman. I'm not trying to sell people on this, but one of the best ways to hedge against inflation, as I'm sure most of your listeners know, gold. My advice would be get some more gold in your portfolio. I'm not saying get loaded up to the gills on it, but I would certainly have some exposure to it, because gold holds its value in inflation. Unlike the dollar, it holds its value. There's something called the men's suit indicator, which shows us that over time, the value of a good quality, or the price of a good quality men's suit, roughly corresponds to the price of an ounce of gold, which shows you that it does hold its value. So I think part of the solution for the average investor is have some gold and some silver, so you can hedge against it.
And you and I differ here because I do think that Bitcoin will have a act as a hedge against inflation. It is a deflationary currency. There will only ever be 21 million. I believe most of those will be lost. A lot of them have been mined already, although it gets real slow over the what's remaining in terms of gold, or rather Bitcoin minting. However, where I differ from the Bitcoiners is that I don't think that Bitcoin is the safe haven of last resort, if you will, or the ultimate safe haven, to use your words. And I think that is, I align with Palantir, who says like they're buying gold as an ultimate safe haven, essentially. But I certainly align with MicroStrategy, for instance, where they see it as like an inflation hedge. Any other comments as we finish up here?
No, I can't disagree with you there as well. We could very well see Bitcoin as an inflation hedge going forward. So maybe it would do well to own a little bit of Bitcoin as well. But of course, I would put the main focus and emphasis on gold and silver. But no, I think we've covered it, and I totally agree with you. Inflation is going to be the word going forward. People seem to be underestimating. They're saying it's going to be temporary, temporal, or whatever. I don't see that. I see it as being persistent and increasing.
We were honored today to sit down with Clif Droke, who is the metals research analyst and writer for Cabot Wealth Network. Thank you so much for joining us, Clif.
My pleasure. Thank you, Justin.
And thank you everyone for listening.